Thank you so much for joining. Today we're going to be talking about the New Development Market Trends Report, the mid-year report, and we're going to be talking pretty much how the demographics and how economics are moving the needle in our real estate market. So the first thing that we need to understand that we are living in a very diverse community. Florida is a pot where everyone is coming from many places. And so we have two main columns that they behave totally different. We have the US domestic markets that they are pretty much driven by the demographic growth, the economy, the employment and wage growth, the stock market, the mortgage, and of course, the tax structure. The international market behaves very differently. It's very much driven by the exchange rate fluctuations, the political uncertainty in some of our feeder markets, the economic market behavior in each one of the domestic economies, the legal and tax risk in the home economies, and the potential treatments with the United States, safety concern that in certain countries, unfortunately, is still a problem, the education and the health opportunities the U.S. offer, and of course, the tourism attractions that we have and the travel restrictions that is affecting right now in the influx of international buyers. So today we're going to try to explain how these two main drivers are shifting the demographics and the buyers pool in our market. If we understand that population growth is a very key element for any real estate market, without population growth, there's no need for new developments, correct, or new supply of inventory. The good thing is that Florida is the state within the United States that is receiving the most number of people per day. We have 902 people are moving to Florida per day. We're expecting the population to be 26 million by 2040. If we understand that a household is composed for, let's say, 2 people, that means that we have 450 units in Florida per day. That is an entire main building in multifamilies or a large condominium. So this is important because that's only the people that moves here. What happened with all the people that come to Florida that they want to buy a second home? So when we try to understand the supply of new developments, it's very important to understand the numbers behind it and how this demand will be composed in the future and what type of products we need to deliver to the marketplace. One of the things that we're living today is the largest immigration trends shift in the history of the United States. If we see this chart, we see in the dark blue the domestic immigrants and in the light blue the international immigrants. And it's not by chance that the states that they are on the far right of the screen are states that they are heavy in taxation. So, and the ones that they are towards the left, they are less heavy in terms of taxes, as we're going to be describing today. So, and the other thing is that New York, California, Illinois, and Massachusetts, Connecticut, they're states where there's a difference in not only the taxes, but also in terms of the cost of living, as we're going to be seeing in the future. The markets that are having the most important influx of immigrants, Florida, Texas, and Arizona, we will see that in the future, and even North Carolina, we're going to see these trends continue to trade because this has been established in the long-term trends that will totally shift the demographics and, of course, the political landscape in this country. In our website, we have seen that a 51% increase from visitors from pretty much for the domestic buyers from the Northeast. We're seeing that Illinois and Northeast with 13%. And of course, the local buyers here in Florida continues to be ranking number 1. From the international markets, Mexico has been a very important feeder market. We all know what's going on in Mexico in terms of the political scenario, the shift to the left, the uncertainty in terms of safety, and a lot of people are thinking of relocating their families and themselves to the United States. Brazil is number 2 with 29%. Brazil is the largest economy in the Americas, outside the United States and Canada, and we believe that Brazil will continue to export people coming to the United States because they are not longer thinking just to have a second home, but they're thinking about migrating on a more permanent basis. Canada will always continue to be an important source of buyers for Florida, not only for us in the east coast of Florida, but also in the west coast and other locations in the state. So why this is happening? So we need to understand that when you decide to immigrate, we have a pure logical and mathematical or fundamentals or financial fundamentals that they are numbers. And then you have an emotional component and the life that you're looking for. On the pure number side of the equation, we are here showing the chart how the Florida is one of the few states in the country that's only tax the income of the individuals based on the federal taxes. So there's no city taxes, nor state taxes, and that is a huge advantage. If we see New York, we can easily see that the taxation could be up to almost 12% more on your individual income than it is in Florida. Los Angeles is heavily taxed as well on the state level. California is extremely aggressive, and Chicago as well. So we're seeing it with about 15 to 13% advantage of having a residence in Florida. On the other side of the chart, we see the cost of living. That we see that New York is the most expensive market to live in, with an index of 241.9, being 100 the average of the entire United States. We see that most of our markets, Broward, Palm Beach, and Miami, they're in the top of the chart. Let's call it that we're 112 to 115 over the index, but that represented enormous savings if we compare it to New York, San Francisco, Washington, and Boston, and Los Angeles. So if we combine lower taxation and lower cost of living, what that really means for the people is you have more disposable income. And the disposable income is what truly drives your lifestyle. It doesn't matter how much you make, it's how much you have left to do the things that you enjoy. And that's what we are offering in South Florida. And that's why the people are moving to our location. And why this is important to understand these two key points is because today in the United States, we have 65 million people. They are called the baby boomers. They are reaching or have reached recently the age of retirement, and they are deciding where to relocate. And all these people are doing exactly the numbers based on what we have in front of us. And if we combine this with the quality of life that Florida brings, can you imagine that we are the only state that you can go into the ocean 9 months out of the year? California is a very strong contender, but the ocean is a lot cooler. You can, if you're brave, you can go 3 months out of the 12 to jump into the water. So we have one of the highest amount of waterfront properties in the world, not only in the United States. We have one of the largest number of golf courses, marinas, tennis courts, and now restaurants, museums, and other cultural activities. They are driving more high-end people towards our markets, especially in the Southeast Florida market. So that's why the long-term fundamentals from the pure demographic point of view for Florida could not be stronger. This is a reflection of what has been happening since the previous recession, when we reset the clock in 2010 and say, okay, how has the real estate prices been affected? This is a Miami index, but it is a good reflection of other markets in Florida. We're seeing that the average appreciation has been 5.6% in average. That is above the inflation rate. But we're expecting this trend to accelerate, as I'm going to describe later, in the next 3 years. We have seen that for pretty much 5 years, we have enjoyed a very strong economic growth that has been totally derailed as a consequence of the pandemic. The first quarter was affected somehow. The second quarter was extremely affected, having the biggest single drop in a quarter since 1929. And that it is unprecedented, because it's not that there was a deceleration, it was a shutdown. So we have never seen these numbers of growth in unemployment. We have never seen this a stimulus package that the government put in place in order to make the economy and the individuals float. We have never seen a cease on the potential foreclosure of the properties and the some protections for the tenants. So this has been extremely unprecedented, and we're seeing a slower recovery in the third quarter, and we expect the recovery to be even more accelerated towards the reaching a better cure initially and a potential vaccine later on. But what has been very interesting, that the pandemic, as a matter of fact, has benefited Florida. We're seeing people, when they're reassessing where they want to live and how they're going to be spending their time, they are not going to be in an apartment locked in with a cold weather outside. And we have seen these people coming to Florida, initially renting properties before it was just for the season, 3 months, and now they're renting for 6 to 12 months, because people are thinking, well, this new scenario that we're living, or we can work from home, why I'm going to stay here? I'm paying more taxes. I'm locked in an apartment. If I go out, it is cold. And all this potential, and even the social unrest that we have seen in other states in the country, we have not seen this level of aggressivity and unrest in the Florida markets. The other thing that I thought it was interesting to show you is what are the predictions of the Fortune 500 CEOs. Most of them, they believe that we are going to reach the pre-pandemic levels in terms of economic activity towards the first quarter of 2022. Some of them, the first quarter of 2021, and quite a lot, they're expecting this to last longer than expected. So what has happened in the market will have like a long-term consequences for many reasons, in terms of activity, in terms of unemployment, in terms of consumer preferences, and more importantly, reassessment of the life that they're looking for. The stock market, we have a huge decrease in the second quarter, but the recovery has been fairly fast. But this is a little bit of a lie. We're seeing very bad performance in some historical well-known stocks, while some IT-related companies have had the best years of their life. Because what the pandemic forced us is a leapfrog effect. So the adoption rate of technologies had jumped about 3 to 4 years, especially e-commerce. You've seen that all of us were doing shopping via Amazon, etc. So this has changed. And that will also have an effect on the technology, how we sell real estate. Then that's why we're seeing a huge consolidation, that the bigger companies are acquiring smaller companies, because if you don't have the critical mass and economies of scale to invest in technology and marketing, unfortunately, you're not going to be competitive. We're living in an age where artificial intelligence, where machine learning are becoming a very important part of our life. And so these adoption rates that we're seeing in the e-commerce preferences, we're going to be seeing some of these trends impacting our industry as well. One of the most positive news about this pandemic, that the interest rate was starting to go up again towards the end of last year, because the Fed was trying to curb down the potential risk of inflation. But then with this pandemic, they reaccelerated the decrease of interest rate to bring more stimulus to the economy and to boost investment, and of course to help the borrowers. But why this is important for us? I think that this is the most important thing that is happening today in the United States. And let me explain you why. United States has been historically extremely leveraged. People are maxing out their credit cards, paying paycheck to paycheck. And what is happening right now with this refinancing of the properties, or getting their properties at a very low rates, they are doing that the household living ratio over the entire household income is decreasing. And that it means that they're going to have more savings. And this more savings is critical in an economy that historically has been very low on saving, except with the top 1%. They are having the biggest year of their life, most of them. And we're seeing that the redistribution of wealth in this country is not going in the right direction. We're seeing the ultra rich getting richer and richer, and we're seeing the people on the lower spectrum of the income pyramid, they're being burned out by the credit card expenses and student loans. So this will have long-term consequences, and that will mean who will be able to be an owner and who will be able to be a tenant, and what type of products we need to be thinking for the future, and what's going to be coming to the marketplace. The foreign exchange now moving more to the international arena, we're seeing that some currencies have been pretty much steady, and some others have suffered a huge decrease at the beginning of the pandemic. And we are expecting, especially Latin American currencies, that this chart you've seen that a huge devaluation in the last few months, that they are going to remain very weak, and that will affect the Miami real estate market more than Broward and Palm Beach, as I'm going to be describing later, because Miami is the most international destination of all our markets, that the ones that we're covering in this report. And that's what we're seeing, that today, in this scenario, the international buyers are, first of all, we have travel restrictions that they're unable to visit the properties. And number two, they have a huge devaluation that, as a matter of fact, the main impact is the loss of affordability of their currencies in order to buy properties in the United States. So that's why we have seen, by the way, this is a trend that started in July of 2015 and accelerated after the pandemic. So that's why we're seeing that while in the past, the buyers for the Miami-Dade County in new developments was 75% foreign nationals. Right now, they are less than 50%. And I will venture to say that right now we're reaching the 42% mark. So that's why it dropped to 47, but I feel now it's even worse. So we are seeing certain countries that they are more active, like Chile, Mexico, but most of them have been affected by this pandemic, and we're not seeing any sign of recovery of the Latin American currencies, at least until the second quarter of next year, where China will start growing again at 9%, and we're going to see a world recovery, and et cetera, that will be taken, and that will trigger the prices of the commodities to go up. Because if the prices of the commodities don't go up, the export of all these countries, they will be deteriorated, and of course that will lead to further devaluations in order to remain competitive. So this is pretty much a scenario at the international level. So we're expecting the international markets to start really kicking in towards the mid next year. And by the way, just before we go forward, why this is important for the new development supply side of the equation. Without Latin America, without international markets, there is zero possibility of launching a project with over 200 units in Miami if you need to reach certain pre-selling requirements. Or you have the cash to build it as you go, and if the sales velocity changes in the meantime, you're okay as a developer. But if you really need to reach a 50% pre-selling requirement, that will take you pretty much 18 months, and the people will not be waiting 18 months for construction. So that's why now in this new development cycle, we're going to see 2-3 things that are different. Number one, we're seeing a higher supply of boutique condominiums hitting the market, or we're going to have larger condominiums but with micro units. And why micro units? Because especially in Latin America, the absorption of new inventory north of $650,000 has decreased significantly, with the exception of Mexico and Brazil. So if you need to count on Colombia, Argentina, Peru, Chile, we need to deliver products that are under 650. So this is exactly what's going on. So we're going to see the new development phase is going to be very different than we have seen in the previous recovery. This chart, I feel that describes perfectly well why we feel that there will be a capital appreciation of real estate properties in the future. This is a delivery profile of all new developments after the 2010 crisis, and you see on the top the number of projects that were delivered in each year, and on top of each one of the bars the number of units. So we have reached the peak in 2019. 2019 has been heavy, but not as heavy. And we're seeing 2020 that it started to decrease, and we're not having significant supply hitting the market. So that will enable us to build a pent-up demand of new developments coming forward, because as I'm going to show you next, once you see that your inventory ran out, you need to start building again. But unfortunately, the supply curve in the short term is very inelastic. So you can, if tomorrow 2 million people moves to our shores, there's no way that we can deliver 2 million units, correct? So we need to build it, and that takes time. A single family homes take 10 to 12 months. A 15-story condo will take 18 months, and a 60-story condo takes you 5 years. So that is exactly why we're going to be seeing that in the future, due to this constraint of the supply, that started to shift in 2015, because that's where most of the projects were delivered 18 and 19 and 20 were launched. Well, the currencies in Latin America were still strong, and they were predicting a much higher number of international buyers, and that would shifted the equation. And when this changed, the developers just stop launching projects. And as a matter of fact, we have 14 projects that were canceled because they were with a dimension or a unit mix that it was not longer attractive for the demand of the market. So this decline in supply will enable two things. Number one, there's only 3,000 units remaining from the entire development cycle that started in 2010, from which is nothing if we compare that each one of our companies could sell almost 1,000 units a year before. So, but right now that will be taking slightly longer. So we're expecting that in the next 18 months, all the new supply will be totally disappear from all the projects that will be delivered, including until 2023. New supply will start hitting the market, but with smaller projects in average. And that would trigger that the resale market will start getting higher absorption, as we're witnessing right now in the single family homes due to the immigration trends and the people buying houses. We're seeing days on the markets dropping significantly. We're seeing that multiple offer scenarios, and we're seeing that the supply of premium properties is becoming extremely scarce. So that's why the market will start appreciation of resale market, opening the doors to the developers to launch new inventory into the marketplace, because as of today, there is a gap about 35% between the price that the developers needs to launch the project and the resale market. And this gap will start being smaller and smaller until it reaches the 20% mark. Once that happens, we're going to see a new development cycle starting, and we expect that to happen somewhere in the middle of 2021. This is pretty much what I was trying to explain to you before. When you acquire a land and you start working on entitlements, we start a reservation phase, you move to contracts, then you do the groundbreaking, then you have all the piling, then you have the concrete pour, then you start building, then you reach top off, and then you to finish. This process takes 5 years. That's what happened with us with 1000 Museum. And that's why it's so important to understand that the supply moves slowly while the demand can react much faster. The other important thing is how our different markets act totally different. We've seen that the biggest market in new developments by far is Miami-Dade, followed by Broward, and then by Palm Beach. And then we see that something very interesting. We're seeing how come Miami-Dade had only 10.5% of all the new development supply left, and Broward 13.3%, and Palm Beach 37%. It's not all the way around. Shouldn't be that Palm Beach is a more stable and more U.S. domestic-based market? Why are we seeing the numbers that they're totally reversed, as they should be in theory? And let me explain you why. The reason is that Broward and Palm Beach, they launched projects long after the developers in Miami starting to build. And they always react with a gap of 18 to 24 months of everything that's happening in Miami-Dade. And that's why the projects up north were having a higher inventory, unsold inventory, even though the units are much less than the ones in Miami for sure. But the important thing is that how this react, how the markets react, and that's what we're expecting, that the domestic buyers, especially from the Northeast, to be filling the gap, and we're going to see more projects coming to the market in the northern territories than in Miami-Dade, because the ones that will be launched in Miami-Dade will be more based for local buyers. Local buyers would be from our own markets or domestic buyers, and they will not count on a significant amount of international buyers. So in a way, the market has been a lot more resilient by having a more local demand. So, by the way, we're going to be, to everyone that is attending this seminar, we're going to be sending the full presentation, about 60 pages, where all this is more in detail explained. The other thing that is interesting is that if you see the percentage sold per area, and we have the dark blue is Miami-Dade, the middle blue it is Broward County, and the light blue is Palm Beach, we're seeing that most of the markets that were supposedly in trouble in Miami-Dade, call it Brickell, Edgewater, we're seeing that they're pretty much sold out, and there's very remaining inventory, and that's very good news, because that will really trigger the resale market in some of these markets. And the overall demographic, the biggest markets have been Brickell and Edgewater and downtown, and in Sunny Isles, that has been the bulk of the inventory hit in the market, being Sunny Isles perhaps the weakest market in terms of these very competitive projects with a very high price point that they were launched. They were counting on Russia, they were counting on Mexico, they were counting on Brazil, Argentina as an important part of their feeder market base, and this has shifted in a way, and that's why we're seeing that Sunny Isles is one of the areas that still needs to absorb a significant part of inventory in the high end. But the good news is that some markets are reaching very strong level of maturity. The closer the bar is to the right, is the market is healthier. So we expect in some of these small pockets, we're going to see new developments hitting the market. So the other thing that everyone asks is that why this time is different, why we're not heading to another crisis in terms of new developments. And we have many differences from the previous cycle to this cycle. One is a pure quantitative thing. If you remember the chart that we presented, that the year where we have most units delivered into our market was about 5,600. Just in 2008, only in the Miami, because this 5,600 is for the three-county area, but only in 2008, in downtown Edgewater and Brickell, there were 10,775 units that were delivered in a single year. So this is pretty much 2 years combined, the two most important years out of the 10 in the entire three-county area. And that was triggered this sharp decline in prices from 2008 to 2010. That was about 50% in those markets. But this is never going to happen again, because the lenders adapted, the buyers have changed their pretty much the way they're buying, and of course the developers, they needed to adapt. In the past, you could buy the land or development site having another loan of about 80% of the value of the land. Right now, most of the developers, they own the land straight up. They are not requiring financing on the land. In the past, we were just requesting 20% deposits. Right now, it's somewhere between 30 to 50% deposits. So the buyers has a lot more skin in the game. So the default alternative, if they decide not to purchase at closing, in a way, is a lot less risky for the developers and the lenders. In the past, we have a low percentage of buyers acquiring cash. Right now, we have over 57% of the new developments are being paid fully cash, especially in foreign nationals. Then the banks with foreign national, they were giving 80% financing. Well, now it's almost impossible to exceed 65%. The underwriting process was the famous ninja loans, no job, no income, no assets. And right now, no, we have gone to a very strict process of underwriting that the banks are really taking the time to analyze the files and truly understand the borrowers. And that's why in certain cases, the underwriting process is taking longer. But I feel that that's good for the economy because we're going to have lower defaults in the future. In the past, the source of funding where the money was coming into the escrow accounts or to the developer accounts was pretty much not monitored by the banks. And now we have the seasoning of the funds. It should be at least 3 months prior to the loan. They need to know exactly where the money came from. No more money being sent out through offshore companies to buy property. So the entire process on the money laundering side as well has been a lot more control. In the past, everyone was pulling the trigger with 50% pre-selling units pre-sold, and right now, some people have been going from 50 to 80% in order to have less risk in terms of the completion. And then, of course, that in the past, as we were explained before, all the units came to the market and in a single year, while now it's a lot more spread out over time. So for all these reasons, we are not expecting in any occasion any a crash landing at all. Where we have seen after the decrease of international buyers' demand, we have seen developers being more open with the terms, in certain cases being a little bit more flexible with the discounts, but we have not seen a scenario that is a distress scenario. As of course that every single building and every single developer has his own story, but in general terms, we don't have a systematic risk at all. And as I mentioned before, we have only 3,000 units left to sell out of this last 10-year cycle. So this is pretty much the same, but it's just put the same, but in numbers. In the previous development cycle, as a developer, your entire equity could be as low as 3% of the entire sellout of the project. So right now, this number is minimum 10% of the development of the total sellout of the project. The banks in the past were absorbing pretty much 55% of the risk in the developments. Right now, they're only taking about 30%. And what has happened is that the usable deposits in the past from the buyers were only 10%, because please remember that 10% when you're building a condo cannot be used towards construction and shall remain in escrow unless you bond these deposits. So in this new development cycle, we're using up to 40% of the deposits of the buyers. So what has changed is the risk profile has been more spread out, and the banks are being a lot less exposed to any downturn in the market. And so the developers are putting more money into the game, and the buyers are putting more money into the game. So that's why now it's a more well balanced, and that's why we're not seeing any strong distress scenario in any way, shape, or form. So this report that we have just been talking about will be shared with you, as I mentioned, via email, and you're going to be having not only the statistics, but you're going to be having different articles about how is the boutique condominium living, the future of the office market. We're going to be talking as well how townhomes are an affordable midway in between condos and houses that is becoming attractive, especially with the Northeast buyers that they're very used to this type of product. So these are some of the articles you're going to be able to find, and I hope you enjoy it. We put a tremendous amount of time and resources to give this information to you. So hopefully you'll read it. The other thing that I would like to share, in our virtual room, that is our YouTube channel, we have been extremely active during the pandemic, and you're going to be seeing that you'll be able to have information about different panels with developers, information about the market and how the office market works. We have a lot of presentations that you can enjoy, and hopefully you learn something new. In terms of our portfolio, it's very interesting as well that since the change in the demographics that we were describing before about the decrease of international buyers and the increase of the domestic buyers, the entire company has undertaken a totally different approach, and we have been acquiring new territories like Boca Raton, Palm Beach, and now the Treasure Coast. And that's very important because each time in our portfolio we're more diversified. We have properties all the way up to Melbourne now, and that gives us a tremendous opportunity to understand different demographics and to adapt our marketing tools and strategies very fast. So just to give you an idea, in our portfolio, we have 1,000 Museum. That is perhaps the most iconic building in the market. We have sold this year $100 million. Girarda Place is fully finished, operational, and is located in the core of Coral Gables. Villa Valencia is another project in Coral Gables that is having the first wellness component that is called the Darwin system by Delos. So the air, the water, the sound, the light, everything is to improve your well-being, and it's one of the most successful boutique condominiums in our portfolio, since we have a tremendous amount of amenities for very few units. We only have 39 units. Marina Palms, we're almost sold out. It's an amazing project in North Miami Beach, with one of the newest marinas in town. We only have about 9 units left. The Addition, that is an amazing property in Miami Beach. We have 1 unit left that is a penthouse, a triple penthouse, and that is beautiful. Then Adagio in Fort Lauderdale, we have a tremendous run. The last 4 weeks, we sold 4 units. I feel we have 8 or 7 units left. 327, we sold the last unit last week, so this out of the way. 111 First Raid, we have about 12 units left. Royal Palm Residence, an amazing property in Boca Raton, overlooking the Boca Raton Resort, is 48 units divided in 3 buildings with very attractive amenities, with walkability to the main restaurants, Mises Park, etc. The intercoastal views is just fantastic, and this is a perfect example of the type of product that the Northeasterns are looking for. And the most recently, we launched Blue at 8050 Ocean in Vero Beach. That is an amazing community in Vero with a direct ocean front. That is, the prices are super attractive. The condos are starting at $1.6 million. On the condo office, we have become the leaders of the condo office market. We have sold out the Ventura Park Square. We are 95% sold in Foro Ventura. Forum Park will be launched soon, and we launched this year Creative HQ. That is one of the most attractive projects that I remember from many point of view. From the office perspective, it's just 1.5 blocks from the Bright Line. Is the Metro Mover station is just inside the building. We have 4 floors of office spaces. We are pretty much 50% sold, and the reality is you can buy a very small office from the low 300s up to the entire floor, that we have the 6th floor reserved for a single buyer. So in a way, this is the only project that will have 70,000 square feet of amenities that could be used by the tenants and or the landlords of the building, with an amazing retail store that's going to be like Italy in New York, with some Mediterranean theme. And of course, you have all the amenities from the top of the building, that is the hotel, the restaurants, etc. So this is a very unique and very exciting project from the office perspective, because it's changing the paradigm that large offices. And so this is going to be totally the opposite. We're going to have small offices, be that their place to meet clients, and a lot of amenities and entertainment, with an amazing logistical from the transportation point of view. So we are launching 2 projects soon. So be on the lookout. We're launching a micro unit project branded in Wynwood. It's pretty much 1 block from Main and Main. It's going to be amazing. 147 units. It's a branded product. It's going to have an extremely cool design element. So be on the lookout. And also, we're going to launch our first in our portfolio, a luxury car storage facility in Palm Beach, 5 minutes from the racetrack. And we're going to be able to offer the suites where the people can have 2, 3, 4, 5 cars with a mezzanine, where you have your living room with the TVs, bathroom. It's going to be an amazing man cave. And the big structure that you see on the north is going to be the spa, where you're going to have AC parking that's going to act pretty much like a museum for antique cars. We're going to be working very close with RM Sotheby's, that is the auction house. And of course, we're going to be doing a lot of events. The brand is just amazing. Just is the most well-known car designer in the planet. That will be the brand. Just I cannot say anything more. So be on the look. And part of how you can access to all our content is we have our monthly newsletter that is called Milestones. We have the first development division app that is one development. You can download it in iTunes or Android, and you have all the information on all our projects. You can access the executive summary. You can share the content with anyone, the brochure via email. You can even airplay the videos of the project in your living room. You can even send the information or how to access the sales gallery, and you can share location, and you can access the sales team 24/7. It's something amazing. Our social media channels are growing. We launched during the pandemic. So please follow us on Instagram, Facebook, LinkedIn, and of course YouTube, where we have most of these videos. And we have an amazing reach in our new email marketing platform. So we have really devoted all this time to build a fairly robust division during this pandemic. Thank you for your time. I hope you enjoyed the presentation, and I would like to open the floor for Q&As on the chat. Thank you so much. Hi, how are you?
We don't have any questions quite yet, so if anyone has any questions, please feel free to ask them in the question box below. We have a lot of great feedback, Fed. Everyone is very, very pleased with the presentation. So thank you, everyone, for your positive feedback. We will make sure to send this out, the recording, as well as a lot of you have requested the slides. So we will make sure to send that out in the email blast that will go out today to everyone who participated. So just a lot of great feedback. We had some friends from TTR Sotheby's, Fernando, so you know, also from Panama Sotheby's joining us. So just a lot of great feedback. So we will send the slides. A lot of people are requesting the slide. Great presentation, excellent presentation. So thank you, everyone, for your positive feedback.
Thank you. Thank you. We are really trying to, we know that the industry is moving towards video. That's why we started with the video. We know that the industry is moving to digital. That's why we're building all this content that will be distributed digitally. And we feel that content is key. We know that we're living in an era where we're going to have more information being automatically generated, but we still feel in the luxury field we need to go the extra mile and to do something unique. And that's why we're putting all the resources to try building the tools, but most importantly, the content that will resonate with our audience. So I thank you so much for your time today. Looking forward to see most of you soon. Rafael, abrazo muy grande para ti en Panamá. TTR team, thank you. Great call yesterday with our team in South Korea. So thank you, everyone. I hope you enjoy it, and we'll be doing more of this to keep you informed. Thank you so much.
Thank you, everyone. Have a great weekend.